Welcome, everyone. It's quite the day, I have to say. I'm so excited a lot of you have been able to join us tonight. And so I am Susan Marshall, your host. If you wouldn't mind, if everybody can hear me, it looks like people are seeing me. That's great. Let me know where you're from. I know we have a lot of people on, a lot of people getting on. For some reason, Google doesn't want to be playing nice. So there might be a little bit of transition between our slideshow and me talking. But this is a seriously important topic to me. Don't go broke in a nursing home. And the reason it's so critical to me is because of my life. Things happen in our lives. Tragedy when I was 38 years old struck, and in an instant, my life completely changed. I became a widow, a single parent with a daughter headed to high school. My boys were headed to middle school. So you wonder what happened. Well, my husband, he decided to go out and fly gliders with the president of the Aero Club. Unfortunately, neither returned. And what's ironic about that is he was an advanced pilot. He had flown fighters, F-4s, F-16s, and the president himself. But unfortunately, the the other advanced pilot collapsed over the stick and they both went into the ground. And I share this story because I know a lot of you have gone through different things in life. Life can be very precarious. And if you've been a single parent, you know the challenges of going forward. If you've lost a loved one, so a lot of times there's a lot of challenges to put your life back together. In 2008, many of you will remember we had a financial downturn. The market plummeted, and the money I was expecting to live the rest of my life on pretty much was gone. What was even worse was I saw a lot of older people that ended up being completely financially devastated. And that's when I vowed to myself that I would figure out how to make sure when people planned for their future, for their retirement, they would be able to have the income they needed to live for the rest of their lives, but also figure out a way to address those risks that really want to get in the way of our enjoying that retirement and being able to experience the life we expected to live. And so that's why I came full circle and I became very, very passionate. And tonight I'm going to switch screens. So bear with me here a second. We're going to speak about one of the top financial risks that people actually do face, that a lot of times it's overlooked. And that's why I want to bring it to people's attention, because it's that risk of long-term care. It's one of the top financial risks. Mostly it's fear of running out of your money, but will I be a burden? And there are some things that we prepare for. We're used to the interest rates, taxes, but a lot of times when it comes to that long-term care risk, we maybe don't understand it. And so we're going to look at the 3 most critical things you need to know about long-term care. Because if you're a couple out there today, the only thing I probably could think of that would be even worse would be than losing your husband, then it would be losing your spouse, your husband or your wife while they were still living. And what I mean by that is if you woke up tomorrow morning and they have a stroke, all of a sudden, they're essentially not really there, are they? And so that's only part of it, because now you have the financial piece of you're going to be spending $6, $7, maybe $8,000, and that becomes the real challenge. How do you find that money that was expected to last you for the rest of your life? Where do you come up with that extra $6, $7, $8,000? And so we're going to look at ways to prevent that and look ahead to that. But first, I do want to give you a word from our attorneys. I know this is a little bit one of those topics most people don't always want to talk about. I do want to encourage you and let you know there's nothing to buy here tonight. It's educational. So when you're looking at the examples, the cases, just know they are meant to be educational, not to be construed as financial, legal, or tax advice. Fair enough? So when I ask you, I ask, so what is long-term care? And a lot of people will give me all sorts of answers. But a lot of times people think, well, it's that nursing home care. And you're right. A lot of times it is nursing home care. But the first thing we need to know, it's so much more than just nursing home care. Many of you may remember the old time policies, and I have to agree with you. If you became financially destitute, I guess you would say, and needed Medi-Cal or Medicaid, you would have to be institutionalized before you could get help or the finances. So I think a lot of times we look at the elderly living there, but if you needed that kind of extended care, it's like help with those personal needs. Where would you want to get that kind of care? In your home, assisted living, or in a nursing home? And they did a Motley Fool study a while back, and they asked people of about $1 million to $3 million net worth. They said, if you needed care, where would you want to receive that type of care? And they said 89% of the people said, in my home, of course. And I will ask you a little bit later to please fill out, it's kind of a survey because I get good feedback on where people would want to get care or in your own place. And it kind of helps us. Some of my clients are people who have said along the way in assisted living because I am done cooking. So if you're feeling that way, you might be checking assisted living as well. But really what also drove my passion is over and over again, people lived a long life. And you see that it's kind of like the circle of life. You start seeing as people get older, their need for care increases. And here, this is my great uncle Jim. He ended up being 106 and a half. So he wins the award of being older. But what I love about this is he planned and he prepared and he was able to stay in his home with his wife of 50 years. They got married late in life. Let me just share that. So they didn't have kids, but the two ladies, they each had their own caregiver. And what I even love even more is they thought out of the box. They took over their whole living room and they had 2 hospital beds and chairs that were able to lift them up. They had their TV, and the ladies each had some bedrooms and quiet time in the back so they could get sleep. But they had round the clock care. And so that brings us to the thought of if you live a long life, the odds get more and more and more that you're going to need care. And I have to mention the lady in the middle is my grandma, and she actually saw 5 generations. So longevity is one of those risks we don't think about. It's one of those things that do want to get in the way of us enjoying our retirement. So that can just be in the back of your mind. I really want to focus mostly on probably the biggest risk. And it's probably the biggest risk because a lot of us really don't think of it, or we underestimate the need. Of course, activities of daily living. These are the personal care items that a lot of times are triggers. If you can't do 2 of them, if you had a long-term care policy or a rider on a life insurance or an annuity, they would trigger a benefit. And these activities of daily living are things like bathing, eating, dressing, toileting, transferring. So I have to ask you, so what is the first thing you do when you get up in the morning? And most of the people say, well, I go to the restroom. Actually, what is the first thing? You backing it up. Some of you might be typing in the chat. I love it if you are. That no, we're actually transferring. You're having to get up out of bed. So if you cannot get yourself out of bed and also toilet yourself, that would be your 2 triggers right there. Also, cognitive impairment. Dementia, that's a growing problem in our society, delirium, amnesia. So many of us, here's Alan, and we all, I think, kind of probably feel like Alan at times. I'm never going to need care. And I'm going to come to his defense just a little bit, because Alan, he's worked hard his whole life. He may have even worked 2 jobs to keep food on the table for his family. He's provided well for his family. And for him to even think somebody would have to take care of him, it's beyond his comprehensive. He doesn't even want to think about it. And you may be thinking that at home, and you might be a woman at home going, well, that's how guys think. Not so fast, because us ladies, a lot of times, we have been probably the primary caregiver of our families. We're cooking, we're cleaning, making sure they're eating healthy, getting enough sleep, running schedules. We may still be working and providing. I get that. But to think that somebody's going to be caring for us is a little bit more of a challenge, especially when you think about all of these different chronic diseases that are coming up. There's stroke. 1 in 5 women. That's a pretty high. It's the 4th leading cause of death for women, and 1 in 5. And I love it when I'm live with people, because we can banter back and forth a little bit. Osteoporosis, generally that's higher in women, but men seem to get a little more affected by it. Parkinson's, it's actually a form of dementia as well as Alzheimer's. However, Parkinson's is more men or women, if you're guessing at home. It's actually men. And then dementia, women or men, who have more of it? Women, 2 to 1. So it'd be a lot more fun if I heard all your responses, but thank you if you're chatting it up. So 70% of people over 65 will need long-term care in their lifetime. And that probability, when you're looking at the whole group, if we all stood up and said, well, I want 7 of the 10 of you to sit down, there's 3 of you sitting up, and we're all standing up. So if you're one of those 3, I don't know which side you're going to pick. You may feel like, oh, good, I'm still standing. Well, you may be the last one standing. And guess what we are? If you're one of the last ones standing, you would be the caregiver. So I do know, though, that even though the probability if you're 65 or older is 70%, the odds get higher as you get closer in your 80s and 90s. It's like 9 out of 10 people will need some type of care. One of the things I do believe is firsthand experience. Many of you have seen this, so you're already there, but most people severely underestimate the cost of care. And there might be a couple reasons for this. Maybe because they think their health plan is going to take care of it, or they just really haven't looked into it. And I think a lot of times people think, well, Medicare is going to cover that, or my health plan will. Well, think back to those activities of daily living: eating, dressing, bathing. They're not medically necessary or considered that. So yes, if you broke your hip and you might have gone into skilled nursing, and now guess what? You get to come home. And I got a call from one of my clients, and she said, you need to go. I need to have my friend call you. And I said, what happened? And she said, well, her mama broke her hip and they're bringing her home. I said, okay. And she said, well, they expect her to babysit her. She needs to go to work. Well, and that's the reality is, yes, they'll come in, they'll help set up oxygen tanks, they'll come in and do physical therapy, but to come in and help cook your food and bathe you, dress you, that's not covered. That's considered long-term care, or actually labeled personal care. But long-term care, that is one form of it. I wrote my book with the Protecting Your Future with Tax-Free Long-Term Care, and I looked at the cost of Orange County, or Southern California, and Nevada. So you'll see a lot of slides. I know some of you are from all over the nation, so I'm welcome. And it might be a little bit late for some of you out in Florida, but I'm so happy that you made it. I see you're here. Hands-off care, hands-on care. There's a couple different kinds of aids. The hands-off care, You don't have to be necessarily certified for that. They come in and help you with the bathing and the cooking and the cleaning. Hands-on care gets a little more personal, but then they start looking at the medications and maneuvering you, making sure you're comfortable, and maybe some personal therapy or bathing and that kind of thing. And it ranges $25 in Las Vegas area versus $31 in Orange County. And I will mention that the cost of care, when you start speaking of inflation, if inflation's running at 2 or 3, it's overall been running about 4.1. So it's higher than just your normal cost of living. So like I said, the Las Vegas area, let's just keep it simple. The cost of care generally runs between $4,000 and $8,000 a month. And if you were looking at that $25 with Las Vegas, and you thought, well, 4 hours of care, that's $100 a day. So that's just slightly, $3,600 or $30,000 for the month, or $3,000 for the month. But that's only 4 hours a day. If you wanted someone around the clock, you can see it could range between 4 and 8,000. And one thing that you're going to also see is a lot of times people are using family, unpaid workers, volunteers to help make up the difference. So homemaker services, we're going to probably average it right at about 6,000 when we do our cases, and that's right in the middle range, which would be 72,000 a year, because you might have home health care a little bit, some daycare, especially if you still need to go to work. And then a private room runs about 10,000 a month or 120,000 a year. And the average cost of care runs between about 4.1 years. Of course, if you have Alzheimer's, some of them you might live 2 to 20 years. And that disease a lot of times is complicated with various other diseases, whether it's Parkinson's mixed with diabetes and that type of thing. So you're getting a general picture of the cost of care being a little bit expensive. One thing that people don't realize is 63% of caregivers are shouldering a lot of the burden of some of the cost. And that's where we bring in the families. I know Miss Dorothy, I helped her with a Medicare plan years and years ago. Beautiful woman, retired. She was a nurse, but she still did some caregiving for an older lady. And then her daughter, when she was in her early 50s, suffered a stroke. Her daughter had gone through some hard times. Well, then Miss Dorothy ended up having to use a lot of her retirement to help take care of her daughter, provide for she needed to have her in assisted living or skilled nursing for a while. But it wiped out Miss Dorothy's retirement. Today I call her and she's well into her 80s. And it's just so hard to listen to her because I know she's in so much pain and she just doesn't have the money and to pay for the help that she needs. So financial demands, a lot of times we think, well, it's not about you, it's not about me, it's about those who are going to be giving care for us. And I always encourage people, look, this is a gift we give our families as well as a gift we give ourselves, because we are many times expected, or not expected, but of course, when you have someone you love, they liquidate their own retirement. 66% of unpaid caregivers are women. Many times the women will leave their workforce. Sometimes they're in the sandwich generation and they have grandchildren at home or their child, and then they're also caring for one, maybe a parent. And that brings it back to their retirement. So what happens to that lady's, the women's retirement, or men's, because that's happened to some of my men that have come across and helped with some of the retirement information. And they took time off of work. They were engineers and they stayed home with their mother, helped them get through it. And then right before this one gentleman went back to work, he suffered an aneurysm and he was in his early 60s. So things happen. And I would probably say that another thing to think about is we think long-term care is only for old people, but is it really? I mean, I'm getting younger and younger people call me, especially since COVID. They're concerned because younger people, age it just doesn't seem to be discriminating. And younger people, yes, there's children that have chronic illnesses and that will need caregiving for the rest of their lives. And we also, when we're planning for this type of care, need to plan for those children or those that are in your care, especially when you're planning for your estate. I always want to look at the impact of survivorship because, of course, the reality of being left suddenly single is a reality to me. But when you look at the impact of it, it's a different story because I wish I could say this is just rare, but a lot of times our income drops when you lose a spouse. And here's Bob and Martha. They receive over $5,000 a month, for $5,400 per month in retirement. And that's not too bad. They're living their life in their dreams. Martha has a Social Security benefit of $1,800. Bob has a pension, $1,500 a month. And then he also has Social Security of $2,100. What happens if Bob passes away? Well, Martha would take one of the Social Securities, and then we have to decide, does she get to keep the pension? And that's the big trick, because many times people will come in and say, what is this? And do I take it as a lump sum, or what is this joint income? And a lot of times Bob could have taken it 100% all in his name. And when he passes on, it's gone. Or he could have said 50-50. So when he passes away, she would still get 700. Or he could take it 100% survivorship where Martha would get to keep the full amount. Luckily enough, she gets to keep the full amount. However, they've gone from $5,400 a month. She's down to $3,300. So how do you plan for that? Do we plan income to replace that? How do you plan for that? Move it forward just a few years. What if there was a long-term care involved event? And we're going to look at that with Linda and Bill. And I just want to give you some perspective, I guess you would say, because these are the things people really don't want to talk about. But then in the end, it could be devastating. And I wish I could say, oh, it never happens. But that's why I get so passionate about, I want to share these things because I know a lot of times it's in the back of our mind. What happens if I lose my spouse, or what happens if I get sick? So let's look at it and let's have a conversation. Let's test it. Let's see what other solutions we have. So Bill and Linda, they're 66 years old. They recently retired. They have a good income base, but they want to remain in their homes. And you may be like them, that you really don't want to be in a nursing home. I know after everything with COVID, I don't even want to go to assisted living anymore. And I thought that would have been the most fun because I love to just go downstairs and play cards and eat. But they do want to leave an inheritance to their sons. And so they said, I don't know if I want to get this long-term care because I've talked to my friends and their premiums keep going up. But they decided, well, let's meet. Let's at least look at a plan and see if there's good options. Well, Linda and Bill's current assets and income, annual expenses, $61,000, a little over that, $61,800. And I don't want you to get too bogged down with all the numbers and details and nitpicky stuff. Focus on the concept and the solutions. And they have a checking account, which is pretty strong, $50,000. So they're looking pretty good. They have an IRA. Both of them have IRAs, which are about $500,000 in assets, and they have between their Social Securities and income, $55,000 coming in. So they're going to use some of their money from their assets to help cover some of that extra that they need. But we're going to assume that their assets are making 4% every year, guaranteed. And if you may know that doesn't always happen, but over time, 4% rate of return. And then inflation's at 3%. So you're going to see the cost of living, like their Social Security, will keep going up 3% a year. And you'll see their investments going up as well. But however, Bill has a stroke. So we're going to stress test this. And he needs care, $6,000 a month. And that's $72,000 a year. So let's see what happens if they don't have a retirement plan. Now, mind you, they have plenty of assets, so they're really not worried about that. So it's been a couple years. So now their income need goes up with cost of living, $67,000. Their Social Security also has increased. Their asset balance is strong. It's growing to be $612,000. And you're going to see the earnings each year coming off from that. They have no shortfall. And then the stroke. You can see the $72,000 is being added on. So it grows. That number goes up each year because healthcare costs go up each year. But the Social Security, if you're looking at that, you can see that's going up each year. Earnings from assets, they're going down. So pause a minute and just notice the asset balance is going down because they're needing that money. Their assets now are needing to support their lifestyle or their care. And that's going down. So they're not making as much from those assets as they dwindle. They're not able to preserve them. So what happens? He passes away at 76. Linda's income needs go down. Remember, she loses one of their Social Security. So now she's down to $37,000 or $38,000 a year for Social Security. Their money from assets is pretty much wiped out. And you can see their asset balance, the first year is $44,000 and then shortfall. And this, I wish I could say, oh, this is an exception. But unfortunately, this happens a lot. But now Linda has some serious decisions to make. Is she able to cut her expenses from 60, 70,000 a year down to 35,000, 38? And this is where you have to make those hard decisions. What are you going to do? If she owns a home, she may have some still other choices that she can do. Now, if we added a long-term care, now this we're going to add an asset-based long-term care. So if you're taking notes, and I hope you are, asset-based long-term care, because it's a little different than your traditional, and we'll go more into that. But that's a good word to know, because you'll know it's not it's one of your assets, and it's not a use it or lose it. You maintain that asset to some level. But anyhow, they put out $14,000 a year over, they're going to pay 10 years of that. So you'll see that money coming in. And then Bill has a stroke, and you see the long-term care policy income, $72,000 comes in each year to cover that long-term care expense. So when we pull this down, you're going to see a couple things. You're going to see that long-term care money coming in for 6 years. The earnings from assets, though, do you see how that stays strong? And then the asset balance is staying strong. So having an asset-based long-term care not only is helping protect their income, it's also preserving those assets. So Bill passes away. You can see that Linda's in a much stronger, better position. She now, when he passes away, she has $489,000, and now she can still use those assets to help, because now she's lost one of the Social Securities, but now she can create a new income, or she has money to live on. So who pays? If you don't have a long-term care policy, where are you going to get the money? And I am going to bring up a couple of you. I noticed when you were filling out those forms, and thank you so much that you gave me some information and asked some questions. And be writing down questions too, because when we meet, I am more than happy to make sure we cover questions that are specific to you or things that I might have glossed over that you wish I would have gone deeper in. But the Veterans Administration, I am going to bring it up. We do have Medicaid and Medi-Cal. Medi-Cal is California's version of Medicaid, but we're not going to go into that. That's very low income to qualify. Veterans is also, they have an aid and assistance program. And the reason I'm bringing it up really quickly is because it's a little unknown. So if you are a spouse or a widow of a veteran and you are very low income, there may be some additional resources and additional funds that you can access. It's tax-free. So you do need to have been at least served one day in one of the wars. And then Leanne, my office, will get you out slides. She always sends those slides so you have details of some of these dates. But the government, let's see. We have the baby boomers. We have over 10,000 baby boomers turning 65 every day. Them alone, as they age, their need for care increases, and we can see the need for long-term care has been growing and growing and growing. And so the federal government has tried to come together and figure out how can we create some incentives to encourage people to get the long-term care. Also, many states are looking at ways they can mandate or create additional state taxes to cover that. Washington put a plan in place. They started to mandate it, but they haven't been able to figure out quite how to monitor it or enforce it. And there's 11 other states right now that are looking into that because it puts a lot of strain on the government programs. But again, you a lot of times have to be very low income to qualify. But on these incentives, and now I know this starts sounding like, okay, Susan, don't get so excited. But when I can save money in taxes and get tax-free money, I get really excited, especially when it saves me money in taxes and I have more spendable money. The pension law, it actually was signed into law around in 2006, but it became effective in 2010. What this did, the asset-based long-term care became an alternative solution to help pay for long-term care. What do I mean by that? We can now use cash value from life insurance. You can now take annuities and exchange them for they probably would consider it a pension protected annuity because then it meets certain qualifications and it comes out tax-free. You can use non-qualified funds and CDs. So it just opened up a lot of different ways to pay for long-term care versus the traditional way. Because when you look at the traditional, a lot of times it's a use it or lose it type of thing where it's kind of like your car insurance, where you're paying money. And if you don't have an accident and don't need a new car, well, guess what? You've been paying a lot in premiums. However, if you ever do have an accident, it is nice to know that you can get a new car or help get back on your feet. I was doing a workshop, kind of like what we're doing, and someone typed in and said, what's wrong with this picture? And I'm looking, guys, anything about this? Yeah, one guy, mostly women. That's a couple things. If you're a guy, and you're a player, it's all going to be good when you're old, right? But seriously, though, women, it just really shows that women do seem to live a lot longer. Unfortunately, we seem to make a little less. So it becomes a little more challenging. So it is a use it or lose it. We already mentioned that. And you do pay an annual premium, and it does have the potential to go up. Especially in California, a lot of the PERS, I've had a lot of calls, people calling in saying, oh, my PERS, we've looked at that. It's almost doubled or it's gone up almost unaffordable. So we've reviewed policies. Some I review for people and they're still a really solid long-term care policy. And for the little bit of money they're paying, they have a pretty great extraordinary benefit. So it's like, no, you need to keep that. But if you don't think your $2,000 or $3,000 is going to be enough, Then let's layer on maybe an asset-based long-term care. And that is, you don't necessarily lose it. You're going to leverage it. What if you could take, let's just say $200,000 and get a $500,000 benefit? What if you said, here, Susan, take $200,000 and go get me a home, but I want it to be at least $500,000 in value. Six would be good too. That'd be one heck of a leverage, right? So the underwriting's a little different. When you still have time to plan, you have additional options, and your health is good. You have more choices. Bob, though, he was out there, and we're going to look at an annuity strategy to use. Like we mentioned, the Pension Protection Act now allows us to use annuities. So don't think all you use is annuities. No, you can fund it using annuities, maybe cash value life insurance, maybe some money that's not doing anything for you. But he had a fixed index annuity that he wasn't all that excited about. And he did want to get some kind of coverage, but he had been turned down in the past. He's like, there's no way they're going to cover me. In fact, I was already turned down a couple years ago. Well, we talked to him and said, look, yes, you've had diabetes, your heart disease is under control, but we were actually able to exchange it for Pension Protection Act annuity. 200,000 was able to grow or be leveraged into a $500,000 benefit to pay for long-term care. And that money comes out tax-free. So if you're thinking like, Bob, well, I know I have a lot of chronic conditions, I don't know, you may have been turned down as well. It doesn't hurt to at least look at your options, or we shop, we'll talk with different companies, because some of them, their underwriting would say, yeah, he's fine. Others will say no. So we can help you find that. And that would be like $8,300 a month, tax-free benefit. And now he has a choice to choose to stay in his home. He could use it at assisted living, nursing home, and some other choices. Leverage your assets. Don't just liquidate. Hopefully you'll figure that, because a lot of us, we may not, let's mention this. We have money potentially. I'm hoping some of us have money, but isn't it great if you can make your money do more than one thing? Or it's hard to know. Maybe you don't have enough. A lot of us send our kids to college. And if you're an everyday person, you may not be able to just send them anywhere you want. If they were really low income, they might have gotten more grants and special assistance, need blind schools. But that middle income, everyday person, guess what? You're going to have to figure out how to be very strategic and how to make your money do more than one thing. And of course, leveraging your assets is a smart, strategic move. Here is an IRA. Using your IRA or 401k to fund the plans for long-term care are now an option where you might be like, Tim, if you were looking at all your assets and you were looking at, okay, I have my IRA, my stocks, I have checking account, I have a savings account, I have miscellaneous money over here, just CDs, and you're looking at all the different things you have. And I said, so like Tim, I said, Tim, you don't have a long-term care plan in place. Where would you get the money if you needed care? And he's looking, he said, well, I'd probably have to take it out of my IRA. He would have to liquidate his IRA. And so I said, well, there was a better way? Would you be interested in looking at that? And he, of course, said, sure. And we're seeing a lot of people like Tim say, yes, let's look at another alternative. But we're going to take just a part of that, just 200,000 of his IRA. So if you're sitting there thinking, well, I have a pretty good size IRA, I've done it with just small amount. You know, some people's IRAs are 1, 2, 3 million or higher, but even a small percentage can be a really nice leverage. So we took 200,000, we took it from one trustee to the other, tax-free transfer, custodian to one custodian to the next. And the good news is He got a $200,000 benefit, but it turned into a bucket of unlimited benefits, not just for him, but also for his wife, for both of them. And so, of course, it's not unlimited in the way of, well, I just want $1 million a month. But they were able to get $6,128 tax-free. That's over $72,000 a year for Tim. And if Patty needed it, she would also get that 72,000. So that's like close to 100, 72 and 72, 144,000 a year for their life, unlimited for their life, that they could use for home health care, assisted living, skilled nurse care. What I really also like is, remember how I said it's asset-based? It's not just a use it or lose it. If he didn't need it and Patty didn't need it, they both died peacefully in their sleep one day, that 204,000 would go as a death benefit to their beneficiaries or to a charity. So you don't just lose it. It still is in your possession. And of course you might say, well, he could have made a lot more money in the market. Well, now what do we like? How are we comparing apples to oranges? Are we protecting our income, preserving our assets? And what would be the rate of return if day one, both of them went into nursing home care? Yeah, it's unlimited. Day one with $200,000 in the market. So it's really not always, are we asking the right question? It's not always about accumulating money, but it's now how do you protect and preserve that money to guarantee and give you those benefits? Protect and preserve. Tom recently diagnosed with early stage Parkinson's. So if you're sitting out there thinking, oh, I just ended up with dementia, but he's healthy. He's out there playing golf, nine holes a couple times a week. And he had a bunch of CDs. But you might be like Tom going, well, nobody's going to say yes to me now because I already have a chronic illness that doesn't have a good ending. Well, guess what? There's one plan out there that allows just one health question, and that is, do you reside in a nursing home or a facility? If that is no, then you could do this plan as well. So we took some lazy money. His CDs were not making that much money, and he didn't need it. And he transferred it to an income account value, which we were able to leverage and guarantee him at age 80, $26,000 lifetime income. And if he could remember those triggers, the 2 activities of daily living that would trigger it, if he needed help with those 2 activities of daily living and triggered that home health care benefit, he would end up with $52,000. Now, what happens if he had $400,000 and he ran out of money? If you kept withdrawing in his bucket, he would go back to $26,000 for the rest of his life. And that's hard to beat. When you can guarantee your income for the rest of your life, it gets exciting. What if he waited till he was 85? Same type of thing. However, he has a much bigger guaranteed lifetime income benefit. But his enhanced benefit, if he couldn't do 2 of those activities of daily living, would be $76,000. Home health care, assisted living, nursing home, however he wanted to spend that money. Now you might be looking here going, well, wow, couple things. If something happened to Tom and he never spent that money because he never needed that money, that would become a death benefit to his kids. It would go transfer to them at $538,000. And what if he had just taken one guaranteed $38,000 payment? And you're like, ugh. Because a lot of times people go, oh, the annuities, you use it or lose it kind of thing. No. 38,000 minus that 538, the 500 would be transferred. So it would go down. And if you ran out of money in the account value, it would go back to 38,000 for the rest of Tom's life. I get excited about this. I know I kind of call it nerdy, but I get excited because I can see the benefit and how it can change our lives, especially when you might be widowed and suddenly single, or you might have had parents who have needed help, kids who have needed help, and you wiped out your retirement. It's always great when you can have a plan in place to help protect your income and preserve your assets. So I'm hoping as we've gone through here, you're seeing that long-term care is really more than nursing home care. It doesn't discriminate with the age, and it can really make a huge difference. Having a plan. Last year, when I had written my book, I was on TV to promote it, just to address the concerns of long-term care, because the book serves to educate and help get those questions answered. And my husband hadn't been able to get out of bed for 3 days. All of his joints, for some reason, just swelled up so bad that he was in so much pain he couldn't move. Luckily, a year later, he's okay. But then I'm thinking in the back of my mind as I'm sitting on stage, oh my gosh, I'm so glad I have a plan that I can pull down and put in place if I need to. It gave me some sense of comfort. It's much better that he did recover. I can promise you that. But people severely underestimate the cost of care. As you can see, the money that you put aside for your lifestyle and your retirement is not money that you want to have to pay long-term care out of. It really can challenge your lifestyle. It can devastate your assets and your savings. And there are ways to plan and protect and preserve your income and your assets. So there are alternative solutions. That was the big takeaway from today, is that even though there's a full array of solutions, the good news is there are now so many different ways that you can pay for your long-term care or alternative solutions to make sure you're taken care of. And that's important, because a lot of times if people think, well, that traditional care, or I would never qualify, revisit that. I'm encouraging you to do that. And I'm encouraging you to I have an opportunity for you to take advantage of a gift that we give ourselves. Long-term care is a gift you give to your families and yourself. The assurance of them knowing that you have a choice of where you get your care, how to pay for it. With the Motley Fool, that was another thing that they, on that long-term care questionnaire, they wanted to be able to pay their caregivers or have that money available to choose who came in to give their care. That's possible. And it's always great to have more control of your money, more control of your assets. The first step is to start by making a plan. And I want to encourage you to come in and visit me. A lot of times people think, well, what do you want to sell me? Again, when we start looking at how to create a plan, or if a plan makes sense, it's really not about selling you something. It's about seeing if there's a solution. If you have a problem, if there's no problem, or if there's maybe a different problem, it's about finding a solution, not trying to sell you anything. And you can just leave your checkbook at home, because we're going to have to find out if it even makes sense, or if you have to qualify by your health also. So it may limit some of your choices. You do have a choice. You can say, I'm okay. I'm going to just hope. I'm going to just hope everything's going to be okay. And that's not really a solid plan, is it? You can always try to figure it out. I know a lot of us are do it yourself. I'm a little bit to blame on that too. But when it comes to knowing about long-term care and those solutions, many advisors don't even know about this. And there's so many different solutions. So find someone who specializes in this type of planning. And also, I'm here to help you get started for free. I'm going to waive any cost of any meetings, because I really do, as I mentioned, when I was putting my financial life back together and trying to vow and find a way to make sure others do not have to be caught off guard, because my goal is for you to be able to really enjoy and experience the lifestyle and live the retirement of your dreams, of one that you've worked so hard for, and I truly believe you deserve. So my goal is to help you protect that income and preserve those assets. Now, some of you may already have someone who's already in a crisis situation or already in a nursing home. I'm going to be putting a survey. In fact, I think Leanne emailed everybody a survey, and it's a Google survey. Put your name on it. I have all your other info. But make a note when you meet with us. We're going to need some extra time to have a conversation about that, because there are some solutions, and we are connected to a full team of highly qualified specialists. I call it my family office. We're team and specialists that we have access to, who specialize in things that most advisors don't, ones that I don't even. Everybody has a specialty. So make sure you put that on your survey, that I want to talk about my mama or my daddy. And a lot of us do say, well, I need a plan for my mom or my dad or so and so. Remember, what about you? If you're the last one standing, you're the one that's going to need help. When everybody else is around to help you, you're fine. The 1-hour consultation and long-term care plan I create for you is a gift for attending this workshop. Encourage people. I'm going to be sending you a link to re-listen to it, share it with your friends, as I want this message to get out. And of course, if it does make sense for you to become a client, or if I can help you, I would love for you to become part of our member family. And as I mentioned at the beginning, I am passionate about this long-term care information. And if you need to put your financial life back together, I understand. Come on, bring it in. But it would be even great if you do have a plan in place. I want you to be able to know that whether you're have good days or bad days, I want you to plan for the good times and the bad times. However, I want you to know financially that you would be okay, that you don't have to worry about everything if your whole world's crashing around you. Many ways to touch base with us. Of course, you can always call our offices and leave a note. You can text. We're going to put the calendar link in the chat box. I do a lot of virtual meetings online, because a lot of my clients have moved out of California, or I've now moved to Nevada. Some of you on the line may not even know that, but we meet virtually. I am in Arizona. I am in Arizona too, but I do spend a lot of time in California and Nevada, and we do meet one-on-one there as well, but virtually and in my office, whether it's in Nevada or in Orange County or LA County. And you're going to get a screen like this. So just schedule a 1-hour call. Generally, if we're going to meet you, if you just want to schedule a time to get to my office or something like that, schedule that 15-minute call, and we'll make sure we set up a good office hour. Or start with a 1-hour call, and we can do a screen share, a Zoom. I like that, because if you have kids that live out of the area, or an estate attorney or accountant, sometimes we bring them in on our discussions, and they're not always there. Even if we're together at the office, we can bring them into our meeting. If you had a chance, you can go on. Maybe you have a phone and you can access it through your phone or off the email that Leanne sent. I would encourage you to put your email in, provide your last name. I love this feedback. Where would you want to get care? I kind of have a survey tally of my own going on. Who would you want to provide care? If do you currently have a plan in place? And then it goes on, if you don't have a plan, which asset would you liquidate? And that's for you as much as for me to think about. Would you want to just liquidate that, or would you rather leverage that? And what other funds that maybe you might have? You might say, well, I have investment properties, or I have a business. There are different things that we do to manage our investments, our retirement. And then what are your biggest concerns? Because a lot of times we each have different level of risk, whether it's fear of losing your spouse or taxes or inflation, but what degree do we have? And you might have bigger concerns than even long-term care. Go ahead and share that. And I do encourage you to meet me one way or the other. Don't be a stranger. I really look forward to meeting you, getting your questions answered, and seeing how we can help. And if we can put a plan in place or put you in a better position or find a solution, it would be my joy. It's a blessing to me to be able to serve. And I'm always grateful for the people who have taken such great care of me. So don't be a stranger. Good luck to all of you, and good night. Please turn in the surveys, of course. And I'm going to go through all trying to close down my screens because it's just technology. I don't know, Leanne, if we have people online that had any last minute questions. And I'm not seeing any in the chat. Hang on a minute. Let me look. All right. Well, enjoy, everyone. And thank you for joining us. You should be commended and to your success and happiness.